John Arnott, ING Direct's Executive Director Customers, joins me now. And John, with house prices increasing so rapidly, especially in Sydney and Melbourne, are we seeing growth in the mortgage market as well?
Yeah, look, we are seeing the mortgage market growing. It's growing approximately 5% per annum. So the total value of mortgages is growing at 5%. Now, historically, that has come back from where it was, but we're seeing continued signs of 5% remaining, what we anticipate to be a longer-term trend.
Because of this, what are the banks and lenders doing to capture that increase in customer?
Well, look, it's pretty aggressive out there at the moment. There's some great deals out there in terms of pricing. There's some great deals out there in terms of kind of fee waivers. So there's good value out there if you're looking for it. I just stress the most important thing is to make sure you're looking at the long-term value. Look beyond the first year, look beyond the second year, look into the full value proposition you're getting on a longer-term period, so you're not getting pulled in by short-term deals that may well come back to bite after a couple of years. So that's important. Customers need to go into this with their eyes wide open.
There is an increasing trend in customers preferring to fix their interest rate on their mortgage, isn't there?
Certainly at the moment there's a trend that fixed rates are attractive and people are lock you in for a period of time, 3, 4, 5 years. It gives them that certainty in the current interest rate environment. However, I would say in 3, 4, 5 years those fixed rates will expire, and certainly the forecast is that interest rates will have increased by that time, and therefore repayments will go up after that period. So again, think about the longer term future, make sure you can afford to pay down the mortgage on a long term basis. Because
of the competitiveness in the market, not just on the buying front but also the financing front, are we seeing, I guess, more mortgage holders refinance with better deals out there?
Absolutely. Existing customers are seeing there's some great deals out there for new customers. That doesn't mean new customers who are entering the market for the first time. People are refinancing their loans to get better deals from other banks. 2 areas for that. One is straight refinancing, but also people are thinking, well, I can borrow money on my house at a relatively cheap price at the moment. So people are renovating, they're expanding, they're extending their houses, and they're borrowing more to be able to afford that, as opposed to moving property. They're upgrading on their existing property.
House prices are increasing, unit prices are increasing, generally in most markets except for Perth. As a result, are people being forced to have bigger deposits? Because obviously it's a percentage of the overall cost.
Absolutely.
Can they afford it?
Well, I think what's very important is the size of the deposit really is king. From a bank's point of view, the bigger deposit, the more protection the customer has, and really there's certainly strong reward for customers if they have a deposit of 20% of the property value or more. That will that will flow through into better pricing, but also it means the customer doesn't have to take out mortgage insurance, which does come at a cost. So the deposit is king. With 2 key trends there, with people are saving for deposits, but also people are accessing deposits through family gifts, etc. Whereas they may not be able to afford it themselves, but they're certainly calling on their friends and relatives to be able to help them out in getting to that deposit.
Banks haven't lowered their mortgage rates as low as the Reserve Bank of Australia has lowered the key cash rate. If interest rates go up, will we see the banks lift rates in line with that, the mortgage rate?
Well, I think it all comes back to the cost of funding for the individual banks. If rates do go up, there is a trend where sometimes banks' rates do follow, but what's important is banks need to look at their own individual cost of funding and they assess their mortgage prices on the back of that.
Are banks concerned at all if interest rates do go up that many mortgage holders won't be able to meet the requirements of those repayments?
I think if banks look at their mortgage holders, certainly over the last 4 years, those mortgage holders have actually been taking out mortgages at a lot higher rates. Now, as rates have come down, those customers have actually held their repayments at a relatively steady level. So that means they're actually overpaying their mortgage. You know, more than 50% of the ING Direct customer base, they're overpaying their mortgage on a continual basis. They're building up a buffer. So if rates do go back up, there's an opportunity there. There's a buffer that customers can eat into. They don't need to adjust their hip pocket or their spending accordingly. It's different for people who are entering the market today. People who are entering the market on, say, a 5% rate. There's certainly not a concern there, but a watch point to make sure customers position themselves for long-term affordability.
So we might be a little bit more prudent in our savings and financial measures than we think we are.
We are prudent in our savings. We continue to save, not necessarily through traditional deposit vehicles, such as high interest online savings accounts, but people are saving through their mortgage. The discipline in saving hasn't gone away, and I think that will continue to increase. We are savers now, full stop, and certainly that's a trend which has changed from 10 years ago.
John Arnott, ING Direct, thanks so much.
Thank you very much.
Cheers.